Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The U.S. Federal Reserve has continued its battle against inflation by raising its benchmark interest rate hike to the highest level in 15 years. The FOMC voted to boost the overnight borrowing rate by half a percentage point, taking it to a targeted range of 4.25% and 4.5%. The increase broke a string of 4 straight 75 basis point hikes, the most aggressive policy stance since the 1980s. Fed Chair Jerome Powell said it was imperative to keep up the fight against inflation.
The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
The rate hike comes with the expectation that the global economy is inching towards stagnation in 2023. Officials received a boost with the U.S. inflation print for the month of November. Government data showed that consumer prices rose 7.1% in the year ending November, the lowest rate this year. Data from across the globe shows that inflation has started ebbing. For instance, prices in UK came in below expectations at a 10.7% in November. A cool-off in commodity prices helped ease pressures, even though high food and energy prices squashed households and businesses. A steep decline in inflation was seen in the Eurozone countries as well, from a record 10.6% in October to a 10% in last month. Inflation was seen easing for the first time in 17 months. The fall comes amid signs that global inflationary pressures are moderating, with significant declines in wholesale energy and food costs. Acknowledging the impact of tighter monetary policy, the Fed members have also gone ahead and cut their growth targets for 2023 by more than half to 0.5% from 1.2% previously. As the central bank lays the path for slowing the pace of rate hikes, investors maintain cautious stance around the risk of Fed having to slow down earlier than expected as the economies need to start absorbing the full impact of the rate hikes. From here on, it's a simple game of wait and watch. Bureau Report, Business Today TV.
If you like the video, do like, comment, share and subscribe.